Hello, my fellow gold and silver stackers. Welcome back to Gold Rush Reporter, where we break down the markets with clarity, not hype. Today, we're diving deep into a forecast that's more bullish than ever, and I mean seriously bullish. This isn't just speculation or wishful thinking. This is about trends that are stacking up in a way that almost guarantees dramatic price moves in silver and gold. So, if you're holding or planning to buy, you need to hear this. Before we get started, quick shout out to Summit Metals, your go-to for gold and silver bullion. Whether you're buying or selling, they've got you covered. Check them out at summitmetals.com. Now let's get into it. If you think silver's run is over, you're missing the bigger picture. Craig Hemke, a veteran in precious metals analysis, is seeing signals that suggest a violent, historic rupture in the market is closer than most people think. And no, it won't wait for retail investors to catch on. The price action may look calm today, but underneath, a massive energy is building. This isn't your usual steady climb. We're talking about a fast, sharp rally that could shock most investors. Past cycles like 1979, 1980, and 2011 saw silver spike quickly, but even those pale in comparison to what Hemke is forecasting now. Unlike previous runs fueled by retail hype, this move is grounded in real physical pressures, structural deficits, rising industrial demand, and a constrained supply chain that's being stressed like never before. Let's put this into perspective. Silver has now entered its sixth consecutive year of supply deficits. Demand, from solar panels, EV batteries, AI chips, and industrial use, is far outpacing production. China is enforcing export restrictions, making global supply even tighter. Physical inventories in Shanghai and the US are at historic lows. Meanwhile, ETF inflows and investor appetite are growing at the same time. This isn't a coincidence. This is a setup for a market that can no longer ignore reality. Hemke points to rare market signals that confirm this isn't a normal cycle. Backwardation in futures, where spot prices are higher than front-month contracts, shows physical silver is more valuable today than in the near future. Rising implied volatility in options, even as actual volatility remains low, signals a market quietly screaming that something big is coming. And don't forget the geopolitical context. The US and China are moving as if on a war footing. Critical minerals, rare earth metals, uranium policies, and global trade tensions are putting additional pressure on silver and gold. This isn't temporary. It's a structural change. Every factor Hemke watches, the charts, the physical flows, and macro trends, points to one conclusion. We are on the edge of a historic rally. Now, here's how you can be part of the action. We just launched the official Silver News Daily Telegram, and to kick it off, we're giving away 10 ounces of physical silver. To enter, subscribe to Silver News Daily on YouTube, turn on the notification bell, comment 10-ounce giveaway on 3 separate videos, and be active in the Telegram group. Once we reach 500 active members, one lucky winner will receive 10 ounces of silver shipped directly to you. Stay with me, because in the next parts, we'll break down exactly how silver and gold could move in 2026, why past cycles won't repeat exactly, and what structural pressures are creating one of the most explosive setups in years. Now let's talk about what makes this rally in silver and gold different from anything we've seen in the past. Hemke isn't just looking at charts or price trends. He's watching fundamentals tighten like a noose. Silver has been in a structural deficit for 6 straight years, with supply failing to meet demand by over 100 million ounces annually. That's not a minor imbalance. It's a sustained squeeze that is quietly building pressure under the surface. On top of that, industrial demand is surging. Solar panels, electric vehicles, AI chips, data centers, all of these require silver, and the consumption numbers are climbing faster than production can keep up. Meanwhile, China has announced export restrictions starting this year. Companies will need licenses just to ship silver out of the country. That's not just friction in the market. It's a real fragmentation of supply. Combine that with historically low Shanghai stockpiles, and you're looking at a situation where the physical market is under intense stress. Hemke points to backwardation in silver futures as a critical signal. For those who don't follow this closely, backwardation occurs when the spot price is higher than the front-month futures price. It's a rare condition that shows physical silver is valued more today than in the near future, and it signals real scarcity in the market. This isn't hype. This is the market telling us that the physical system is under strain. The options market adds another layer of evidence. Implied volatility is rising even as realized volatility remains low. That divergence is extremely rare and meaningful. It's the market's way of saying that a significant move is coming and it's being built quietly, under the radar of most investors. Unlike the retail-driven frenzies of the past, this is a structurally driven setup. We also need to consider geopolitical pressures. The US and China appear to be positioning themselves for long-term strategic control over critical minerals and rare earths. The US is working to secure domestic production of uranium and other essential resources, while China is restricting exports. This isn't a short-term policy. It's part of a broader strategy that makes metals like silver and gold more scarce. Scarcity equals higher prices. It's simple economics, and the physical market is already reacting. On top of all this, ETF inflows and investor appetite continue to rise. Gold is pushing record highs, and silver is starting to catch up. Yet the market structure remains fragile. Futures contracts may appear plentiful, but when you account for inventory that is already allocated or tied up in physical demand, the available float is razor thin. Hemke warns that if one or two large players demand delivery at scale, the paper market could collapse, triggering a rapid repricing of silver and gold. Even market skeptics should recognize that this isn't just another cycle. Past rallies, like in 1980 or 2011, were explosive, yes, but they were often fueled by retail speculation and panic. Today's setup is different. This is a convergence of structural deficits, industrial necessity, geopolitical scarcity, and rising investor demand. The potential for a violent, rapid move is far higher than most people realize. And let's not overlook the timing. Futures and spot markets are aligned in unusual ways, and any disruption in these already tight systems, margin hikes, liquidity changes, or geopolitical shocks, could accelerate the move. According to Hemke, the calm we're seeing now is deceptive. It's not a signal of weakness, it's a loaded spring, waiting to explode once the structural pressure can no longer be contained. In short, silver and gold aren't moving because of headlines or temporary panic. They're moving because of real systemic pressures that are building over years. If these trends continue, and all signals suggest they will, we could be on the verge of a historic repricing of precious metals, one that could redefine investor expectations for the decade. Let's take a step back and look at silver historically, because it gives us context for what Hemke is projecting. Think about 1980. Silver went from under $6 to nearly $50 in just a few months. That move was vertical, violent, and detached from what most investors thought was possible. Then in 2011, silver again surged from around $9 to just under $50 in under 3 years. Both times, the market didn't move gradually. It erupted once certain pressures, physical shortages, rising demand, and investor interest hit a tipping point. What Hemke is warning us about today is similar in nature, but the underlying distortions are far deeper. This isn't speculative frenzy or retail-driven hype. Today's rally is systemic, structural, and supported by multiple forces, all converging at once. The deficit in physical silver has now stretched to 6 consecutive years, totaling hundreds of millions of ounces. Industrial demand continues to accelerate with solar, EVs, and tech industries consuming more silver than the market can supply. Meanwhile, China's export controls, combined with US critical mineral policies, are creating a global fragmentation of silver supply. This isn't a small ripple, it's a widening structural crack in the foundation of the market. Hemke also emphasizes the difference between paper markets and physical markets. Futures contracts, COMEX listings, ETF holdings, they give the illusion of liquidity. On paper, supply appears adequate. In reality, when you remove registered ounces already allocated to contracts, the available float is razor thin. 1 or 2 large players demanding delivery could collapse the illusion overnight, forcing a violent repricing. This isn't theoretical. It's been quietly building for years. The paper market can only sustain so much pressure before the physical reality asserts itself. Now, let's talk price targets. Hemke's forecasts aren't wild guesses. They're based on structural and historical analysis. He sees $100 silver as just the ignition point. Beyond that, we could be looking at $200 or more if the underlying physical stress continues. Gold, following similar dynamics, is expected to push well past previous highs. Some analysts even model scenarios where gold reaches $5,000 to $6,000 over the next year or two, with silver's surge being amplified due to the historically high gold to silver ratio. That ratio, which measures silver's value relative to gold, remains stretched. Historically, when it snaps back toward equilibrium, silver doesn't just catch up, it overshoots, often violently. What's important to understand is the speed of these moves. Hemke argues that we're not in a slow, orderly climb. The charts show calm price action now, but options markets signal rising, implied volatility. Futures show backwardation, and the structural deficits are mounting. This is a setup for a rapid, almost explosive repricing once the pressure can't be contained. Unlike previous cycles, the catalyst isn't retail panic. It's systemic scarcity. Even short-term disruptions can accelerate this. Margin hikes in Shanghai, rebalancing of futures indices, or shifts in US policy all act as accelerants. Small events in this tightly wound system can trigger outsized reactions. This makes monitoring both physical flows and derivative markets crucial. Finally, the geopolitical backdrop amplifies the effect. US and China are both strategically controlling resources, securing critical minerals and limiting exports. Supply-side constraints from these policies are not temporary, they're structural. When you combine that with industrial necessity and record ETF inflows, you get a recipe for a breakout that is both inevitable and historic. In short, the market conditions for silver and gold are unprecedented. The forces aligning today, structural deficits, industrial demand, policy pressures, and investor behavior, create a situation where a violent, rapid move isn't just possible, it's probable. This is why Hemke's projections for silver at $100, $200 or beyond are not hyperbole. They are the logical consequence of the system finally reconciling the scarcity and the value of these metals. Now that we've laid out the structural story, let's zoom in on the short-term catalysts that could push silver and gold even higher before the systemic move fully materializes. One of the biggest factors right now is the ongoing volatility in both the futures and options markets. We've seen implied volatility rising even as realized volatility remains muted. That divergence is not just technical noise, it's a warning. the market is quietly signaling that supply is tightening and pressure is building. Options traders are anticipating a move, even if it hasn't arrived yet, which is rare and meaningful in the metal space. On the futures side, backwardation continues to appear in silver contracts. That's when the spot price is higher than the futures price, indicating a real physical stress in the market. It's a warning sign that the paper market isn't capturing the real-world scarcity of silver. When you combine backwardation with shrinking COMEX stocks, limited registered ounces, and growing industrial demand, you create a perfect storm for a rapid repricing. Unlike in past cycles, there's no speculative mania driving this. The pressure is coming from real-world physical stress. Supply simply can't keep up with demand. Geopolitics is another accelerant. The US has taken a much more aggressive stance on critical minerals, rare earths, and strategic resources. China has implemented export restrictions, requiring companies to apply for licenses to move silver out of the country. Meanwhile, ongoing US trade policy, tariffs, sanctions, and strategic stockpiling further fragments global supply. Each of these moves limits available silver for investment and industrial use, creating a bottleneck effect. These aren't temporary fluctuations. They are structural changes that will persist, and they're exactly the kind of pressure points that Hemke says trigger a violent market breakout. Even short-term events can have outsized impacts. For example, upcoming US labor and economic reports will influence the dollar, treasury yields, and equity markets, all of which correlate with gold and silver. Meanwhile, court rulings on the legality of previously announced tariffs could instantly expand or contract demand, creating sudden price swings. In a market already under structural stress, these small catalysts can amplify volatility dramatically. Investors also need to understand the behavior of high-frequency trading and institutional players. Even when gold and silver make major moves, mining stocks and ETFs often lag because automated trading systems ratchet prices intraday. That creates opportunities for long-term investors to accumulate at levels that might seem expensive on the surface, but are actually undervalued relative to physical scarcity. Hemke emphasizes that the disconnect between paper and physical markets means retail investors need to focus on fundamentals, not just intraday price action. Physical demand continues to drive the market. Large buyers, central banks, ETFs, industrial users are quietly accumulating metal, even as the mainstream narrative underestimates the deficit. The current 6-year deficit in silver, combined with rising industrial consumption and fragmented supply chains, has set the stage for a price move that is much larger than anyone is anticipating. Once the market finally reacts, the velocity of that move will overwhelm traditional expectations. Finally, this setup changes how investors should think about risk. Silver and gold are no longer just safe havens or contrarian assets. They're strategic assets that respond to systemic stress, policy shifts, and industrial demand. That means volatility is expected, but it's part of a larger trend that is fundamentally bullish. Instead of reacting to every headline, investors should focus on structural signals, physical availability, and market positioning. Accumulation now, before the broader market catches on, could be the most important move of the year. In short, short-term catalysts, option signals, backwardation, geopolitical pressures, and economic releases are all converging on a market already strained by structural deficits. These forces could trigger the explosive move Hemke predicts, and history suggests that when silver finally erupts, it will do so violently, leaving most investors scrambling to catch up. The key takeaway is that this is not a normal cycle. It's a structural reset in the making. As we move into the final part of this outlook, let's focus on the big picture forecast for 2026 and what it means for gold and silver investors. Craig Hemke's analysis, combined with current supply-demand trends and geopolitical pressures, point to a market setup that is historically rare. The structural deficits, rising industrial demand, export restrictions, and investor accumulation are all aligned to create an explosive scenario for precious metals. Starting with silver, Hemke isn't talking about a slow grind higher. He sees a violent repricing ahead. $100 an ounce is just the ignition point, not the ceiling. With the gold to silver ratio still historically elevated, silver has room to overshoot expectations dramatically once the physical stress in the market fully impacts prices. If industrial demand from solar, EVs, and AI chips continues alongside sustained ETF inflows and geopolitical fragmentation, silver at 200 or even 500 is not fantasy. It's mathematically supported by structural fundamentals. Gold follows a similar trajectory, though its moves tend to be steadier due to its larger market and central bank holdings. That said, we've already seen gold break past previous record highs, and as dollar weakness continues and treasury yields fluctuate, gold remains a prime target for capital seeking safety and real value. Current forecasts from LBMA and ICBC Standard Bank indicate potential ranges as high as $6,000 to $7,000 per ounce. Even accounting for volatility, these numbers underscore the systemic nature of the rally, rather than a mere cyclical spike. One critical point for investors: this isn't a retail-driven frenzy. Past rallies in silver, like 1980 or 2011, had a strong retail speculation component. Today, the drivers are structural: physical scarcity, geopolitical constraints, industrial necessity, and fractional reserve pressure in the paper market. That means traditional indicators like daily volume, RSI, or short-term trends might not reflect the true underlying forces. Instead, focus on backwardation in futures, vault stock depletion, and global ETF accumulation as the key signals. Volatility will remain a factor. Margin hikes, court rulings on tariffs, economic reports, and market rebalancing are all potential catalysts for sharp daily swings. Expect big intraday moves in silver and gold, but recognize that these are part of a larger trend. The structural thesis remains intact even during short-term pullbacks. A 3 to 5 daily swing should be seen as normal in this environment, not as a reason to exit positions. For stacking strategy, now is the time to build your positions thoughtfully. Physical metal, coins, bars, and allocated bullion should be prioritized. Paper positions and ETFs can complement, but the structural shortages in silver make physical accumulation particularly crucial. Gold should also be maintained as a hedge against systemic risk and currency debasement. Diversification within physical holdings, different mints, sizes, and sources reduces risk and ensures liquidity when demand spikes. Finally, stay informed. Follow credible sources like Hemke, TF Metals Report, and market analysts who focus on structural trends rather than sensational headlines. Remember, this isn't about timing the peak perfectly. It's about understanding the setup, recognizing the systemic pressures, and positioning yourself ahead of the broader market realization. In conclusion, 2026 could be a historic year for precious metals. Silver's potential for parabolic moves, combined with gold's role as a store of value and hedge, creates one of the most compelling setups in decades. The key takeaway: this is a structural, physical-driven market, not a speculative cycle. For investors and stackers who understand the underlying forces, the opportunities are unprecedented. The storm is brewing, and the prudent position is to be prepared, physically allocated, and informed. So, whether you're an active trader or a long-term stacker, the path forward is clear. Recognize the structural forces at play, accumulate smartly, and be ready for volatility. Because when the market finally erupts, there will be little warning, and the upside could be historic.